In this video, I am going to analyze companies which are into graphite production. Graphite India, HEG and Panasonic Carbon are the three companies which are in this segment, and we will be analyzing these three based on around 64 ratios. All these ratios are very useful in understanding how the company's fundamentals are, and these ratios can be obtained from screener.in or even moneycontrol.com. These ratios serve different purposes in the sense that there are valuation ratios or valuation metrics which helps us understand where the price is or how high or low the price is compared to different variables like price earning, price cash, price book, price to free cash flow, price to sales, and so on. Then we have return ratios like what is the profit generated on shareholders' money, or what is the profit generated on total capital employed, or how much was the profit on the invested capital, and so on. And then we have sales growth ratios like price to sales and profit growth rate, and so on. So we are going to analyze all of these, and this video won't be too long because we just have three companies to analyze. So let's start with Graphite India. The data we have up to date is up till March 19. HEG's is up till March 2018, and we have the last 12 trailing months data up till March 2019. Similar is the case for Panasonic Carbon, for which we have data up till 12 trailing months or up till March 2019. Graphite India's current market price is 402 rupees, and it is down from 52 weeks high at 64%. HEG's had a fall of 73% from its 52 weeks high, or where it was 52 weeks back, meaning the price was quite high around 52 weeks back. Panasonic Carbon too has fallen by 48%. The maximum fall was seen in HEG at 73%. Now, this fall is generally a good indication for us to either buy into it, or maybe it will show a strength if the fall is not that much. So, of the three companies, Panasonic Carbon has fallen the least at 48%. So that may show us a strength. But for buying, we want to buy good companies, good fundamental companies at a discount level or at a very low price, and that gives us an advantage of buying low and selling high. Of course, we have to buy only those companies which are fundamentally strong and yet falling in price. That's a advantage that we can take in a falling market. Let us look at the earnings per share of the latest 12 months up till March 2019. Graphite India earned 173 rupees on price of 402 rupees. That's an earnings yield of 43%. That's a very high earnings yield. HEG2 earned 763 rupees on a share which was costing 1318 rupees. That's a very good earnings yield of 57%. Panasonic Carbon 2 had an earning yield of 8.7%, which was way too lower than the previous two companies. On a price of 294 rupees per share, the company had an earnings of 25 rupees. That translates to 8.7% of earnings yield. Now this earnings yield is of just last year or of the 12 trailing months. or up till March 2019. Let us look at the price to earnings multiple of the latest 12 months data. When we consider the latest price and the latest earnings, we find that Graphite India is trading at 2 times its earnings, which is very reasonable. By just paying 2 times the earnings, we are getting the share of this company. So we can see the price was 402 rupees and the company was earning 173 rupees behind that share. So that was just a 2.32 times. HEG was even available at a much lower rate of 1.73 times. That is, the price 1318 rupees was just 1.73 times the earnings of the company of 763 rupees. Panasonic Carbon price earning was quite high at 11 times. That is, on a price of 294 rupees per share, the company was earning profit of 24 rupees. That is a multiple of 11.4 times. The last year's price earnings of both Graphite and Panasonic is similar. HEG's last year, that is 2018's, price earning multiple was 4.8 times. That is, the price was 4.8 times higher than the earnings of 2018. So this particular ratio, PE ratio or price to earnings ratio, helps us understand where the price is when compared to the earnings of the company. Now, 1 year price earning value can disturb the outlook. So we need to look at a long-term historical price earning. So here we have 5 years of historical price earning values and even 3 years price earning average values. From last 5 years, the price to earnings multiple were 18.9 times for Graphite India and 12.9 times for HEG and 14 times for Panasonic. Now what we can do is we can also compare these 5 years historical price earning value and see where the current price earning multiple is. So we are getting at a very reasonable rate of just 2.32 times when we compare it with its 5 years average. Similar is the case for HEG, where it's historically the price was trading 12 times more than its earnings and the latest price earning is just 1.73 times. Now the reason why we are getting it at such a low multiple is that in the last year or the latest year, the company's profits or earnings have increased tremendously, almost 3 times of what it was in 2018. That is why even though the price is very high, the earnings has also gone up to meet up with the price and thereby bring the price earning multiple down. This is what investors should look at, that earnings increasing and even if the price is falling, it's okay, but the price to earnings multiple should be as low as possible, and that helps us into buying decision. Let us look at the 3 years historical price earning. Graphite India was trading at 16 times more than its earnings. HEG was trading at 17.7 times its earnings of the last 3 years, and Panasonic was trading at 16.5 times. Now compare these 3 years historical price earning values with the current price earning of the 12 months and we see Panasonic also has fallen below its historical price earning of 16 times. This is also reasonably available. The lowest price earning multiple, the better it is. So the maximum fall was in HEG at 73%. And the lowest fall in price from 52 weeks high was in Panasonic at just 48%. The earnings yield highest was for HEG at 57%, and the lowest earnings yield was Panasonic Carbon. Price earning multiple in the latest 12 months was highest for Panasonic Carbon, the most expensive, and the lowest price earning multiple was for HEG at just 1.7 times. Last year's price earning multiple, that is 2018 value, was of Graphite at 2.32 times, whereas Panasonic Carbon was the again most expensive at 11.49 times. 5 years historical price earning, Graphite was trading at 18.9 times, most expensive. HEG was the most reasonable at 12.9 times. 3 years historically too, HEG was quite expensive at 17.7 times, and Graphite India's shares were available at 16 times its earning in the last 3 years. Also, again, if we compare these historical price earning values with the latest price earning, and if you find that the latest price earning is below both the 5 years historical price earning and 3 years historical price earning, then that's a good value buy to buy the shares of the company. Next, let us look at the price to operating cash flow and price to free cash flow. These two ratios we'll look at together. Understanding a price to operating cash flow is very important because the operating cash flow signifies how much of the earnings has got converted into cash, and the free cash flow also is also very important to understand because that gives us an indication what is the cash balance that the company had at the end of the year. To give you an example, let us look at the profit earnings and cash earnings. What is the main difference? So what we have here is we can have a price earnings ratio and we can have a price to cash ratio. Now I am trying to make you understand what is the difference between the profit earnings and the cash earnings. So let us take an example of sales. If the company made a sales of 1,20,000 in the latest year, it will take that entire sales as revenue, whereas it may have received only 80,000 from its customers and 20,000 may still be pending, but it will still show entire 1,20,000 as its earnings even though it has not received the balance of the 80,000. Next, we'll look at the purchases. The company did a purchases of 80,000 for example, and 80,000 went out. That is what the company shows, but in actuality it only paid 70,000 for the purchases. That is, it paid 10,000 rupees short and it will pay it after some time. That is, it has done credit purchases. Depreciation is a non-cash expenditure and no money goes out of it. It is just a depreciation in the value of the assets. So what happens is it is removed out from the profit or from the revenue of the company to calculate the profit, but as such no cash is going out of the company. This is just a book value to reduce the asset and increase the expenditure, but as such no cash is going out of the business. Now let us look at the debtors and the creditors. The debtors of the previous years paid us 15,000 which was pending, so the cash came in, but there was no entry in the profit and loss account for the debtors because that had already been accounted for in the previous year, but in cash it wasn't, so it got accounted in this year when the debtors actually paid cash. Same thing is with the creditors. The creditors we paid to the creditors 10,000 rupees and that was for this year in cash, whereas no entry will go in the profit and loss account in purchases, because at that in the past year we had already accounted for that in the purchases. Finally, let us look at the write-offs, asset write-offs. If the company feels that certain assets that it had purchased or acquired in the past has no further value or has no resale value to it, it may have to write off that assets. So, for example, the company wrote off 10,000 CR of assets. Now, no cash is going on, but it will still show it as an expense in the profit and loss account. So now what we have total here is a 25,000 rupees of profit at the end of the year, whereas in the cash earnings we just have 15,000 rupees. So there is this difference between the profit and the cash. Normally we would want to see whatever the company is showing as profits or earnings gets translated into cash at the same rate or maybe even more than what the company is showing as earnings. That is, more cash should come in through operations of the business. Now let us continue with the Graphite India analysis of the price to OCF. So now you have understood what the OCF is, or operating cash flow is. This is the money or cash coming in to the business through the operations of the company, and that too only cash coming in and cash going out. So Graphite India's share price was quoting 3.3 times higher than its cash earnings, which is good. If we compare this price to cash with the price earning multiple of the latest 12 months, we see that they're both very nearby each other. Price earning is 2.32 times and price cash is 3.3 times. We would want to ideally see the price to OCF below the price to earnings ratio. This way we know that the company is converting most of its profit into cash. HEG's price to operating cash flow was 8.6 times. That is, the price was quoting 8.6 times higher than its cash it received from operations, whereas price earning wise it was available at just 1.73 times. Here too we would want to see the price to cash below the price to earnings ratio. Panasonic Carbon's price to OCF was high at 15.5 times, whereas price earning multiple was 11 times. It's the same for all the three companies, that the cash is price to cash ratio is more than price to earnings ratio. Let us look at the free cash flow. The free cash flow is the cash that the company finally has after it has done all the investment related activities and whatever funds it has received from operations, deducting the capital expenditure from that. So finally what cash the company has can be used for distribution to the shareholders as dividend or buyback or bonus or whatever, or maybe acquisition of other companies. So here too we want the price to cash free cash flow as low as possible, like all the other price to earnings comparisons. For Graphite India it was available at 3.44 times. Now what this particular ratio signifies is that the profit, the cash that the company earned from operations, most of it the company still has in its free cash flow. There's not much of a difference between the OCF and the free cash flow. Later down the ratios we will understand what is the actual value wise in the last 5 years, how much of the profit is getting converted into cash, and out of that operating cash how much is still free left with the company to use for the financing activity. HEG's free cash flow is 8.9 times its price. That is, price was quoting 8.9 times higher than the free cash flow, which is quite high compared to Graphite's. Panasonic's price to free cash flow is very high at 16.8 times. We want these ratios to be as low as possible so we get a good buy at a discount. Let us look at the price to book value. The book value signifies the net worth of each share, or we can also say what is the actual value of a share as per the company's books or company's records, or what the company is saying its shares are actually worth. And then we compare that with the market value of that share. So we get an understanding at what premium or at what discount the share price is when compared to its actual value as quoted by the company. Graphite India's price to book value was 1.47 times. That is, the price was 1.4 times higher than the share's actual value. Here too, we want the price to book value as low as possible. HEG's price to book value is at 1.3 times, and even Panasonic's is at 1.3 times its book value. Now, price to earnings, price to cash, and price to free cash flow should all be below 25 times. That's the first criteria. And then, if the ratios down the line are getting worse or not up to the mark, then we have to still lower down our price earning multiple or our price cash multiple to 20 times, or maybe even lower than that for our entry. Next, we'll look at price to sales. This ratio helps us understand what was the market cap against the sales of the company. So if a company did a sales of 100 and the market cap of the company in the share market was 200 cr, that is a price to sales ratio or market cap to sales ratio of 2 times. That is, the price was 2 times more than what the company did as sales. Here we don't want the price or the market cap of the company going way higher than what its sales value is. This is a very good indicator of how well the company is valued by the investors in the market in terms of its sales. So if the market cap is way too high than the sales, Graphite's current market price to sales ratio was 1 times. That is, market cap and the total sales were almost the same. HEG's sales were more than the market cap. So what we also want to see in companies is that the sales and the total market cap or the valuation that the investors have given in the market is similar. For Panasonic, the price was 3 times higher than its sales, so it was trading at a premium. Investors were valuing this company very highly against its sales. Next, we'll look at the profit growth of the last 5 years. That is how the profit had been growing from past 5 years. Graphite India's profit has grown at the highest rate of 97% compounded over last 5 years. HEG's profit has grown at the rate of 47% in the last 5 years, whereas Panasonic Carbon's profit has grown at a reasonable rate of 13%. We want to see a growth rate of more than 10% over a period of years. Looking at the last 3 years growth rate, we see that both Graphite and HEG have done exceptionally well in growing their profits at the rate of 246% and 209% over a period of last 3 years. Panasonic Carbon grew reasonably at 10%. Now, when we look at such high percentage growth rate, we have to understand where the base price was or the base year's value was. From there, if the current profit is way too high, then we'll see such kind of growth rates. Alternatively, if this year's profit is normal but 3 years back or 5 years past the profit was very low, then also we'll see such kind of high growth rates. But for these companies, Graphite India and HEG, both the current year's profit are exceptionally high. So these are good growth rates. So price to OCF, the best was Graphite, available at just 3.3 times, and Panasonic was available at 15 times its cash earnings. In terms of free cash flow, the lowest price multiple along with the free cash flow was of Graphite India at 3.4 times, whereas Panasonic Carbon was trading at 16 times its free cash flow. Book value wise, the lowest book value is of HEG, available at just 1.3 times, and the highest price to book value comparison was of Graphite India. This was the most expensive of the three companies when compared to the book value. In terms of sales, the highest difference between the sales and the market cap was of Panasonic Carbon, very expensive at 3 times when compared to the other two companies. HEG was available at discount to the sales price, that is, sales was more than the market cap. In terms of profit growth rate for both 5 years and 3 years, Graphite has done the fastest growth rates, and Panasonic's growth rates were at nominal 13% and 10% in last 5 years and from past 3 years. Next, we'll look at the PEG ratios of the company. PEG ratio stands for price earnings to profit growth rate comparison. Here what we want to do is we want to compare the price earning that we calculated earlier of the recent 12 months and compare that with the profit growth also, which we saw just one ratio back. So we'll need to use the profit growth rates and the price earning So, the price earning paid for Graphite India was 2.32 times, whereas we're getting a growth of 97% since past 5 years. Now, when we are paying 2.32 times and we are getting a growth rate of 97%, it means the PEG will be 0.02. What this particular number signifies is that we will be able to recover our capital, our price that we paid against the earnings much faster, because the earnings itself is also growing at a very fast pace. So when we pay a certain price earning multiple, what we are basically doing is we are paying against the earnings of that company, a multiple of that earnings. And if the earnings has a good growth rate from past 5 years as a benchmark, from past 3 years, then it signifies that our initial price that we paid against the earnings will be recovered at a very fast pace. So we want to see a ratio, PEG ratio, between 0 and less than 1.5. For HEG2 also, PEG ratios were 0.04 and 0.01. These ratios are very good ratios, which signifies the price earning multiple we are paid is justified. Panasonic's is also within the range, but the highest of the group, 0.85 and 1.13. For Panasonic, we were paying 11.49 times, whereas we are getting a growth rate of 13% and 10%. Now this PEG is calculated by dividing the price earning with the profit growth rates of the 5 years and profit growth rates of the past 3 years. Next, let's check the sales growth rate of the company for both past 5 years and from past 3 years, how the sales have been growing. This ratio helps us understand how well the company is managing to increase its sales year on year or from past few years. This ratio also helps us understand whether there is demand for the company's products, what the company is manufacturing. If there is no demand, then the sales will fall from where it was 2 years back, 3 years back, 5 years back. So we want to see a healthy growth rate in sales of at least 10% year on year from past few years. So, Graphite India's sales has grown at the rate of 31% over a period of 5 years, and over a period of 3 years it has grown at the rate of 72%, which are very healthy growth rates. HEG's sales has grown at 11% and 30%, whereas Panasonic has managed to grow its sales at a very low pace of 4.5% in last 5 years and 1.97% in the past 3 years. Let's move on to the return ratios. Return on equity. We'll measure three of these ratios together. ROE of the last 5 years on average. What was the company's earnings or profit against what the shareholders have invested, that is the equity, and what was the current or latest return on equity, and then what was the growth rate in that equity, whether 5 years past has it been growing or from 5 years past has it been falling. So this helps us understand not only the returns that the company has earned on the equity shareholders' money, but whether that returns are growing over a period of years. ROE should be at least 15% and above for each company. Graphite India had earned 39% on average since last 5 years. HEG's return on equity is 23% on average, whereas Panasonic is 15.4%. All the three companies have done well. Latest year's ROE was 84% and 80% for both Graphite and HEG. These are very high growth rates. Generally, you don't see such kind of growth rates, but due to exceptional profit in the latest year, the company must have had a good ratio for that. Panasonic Carbon too has managed a recent ROE of 13%, although we want to see a value of at least 15% and above. Let us see how the ROE has grown from past 5 years. From where it was 5 years back, the today's ROE has grown by 66%. HEG's ROE has grown at the rate of 33%, and Panasonic's ROE has grown at the mild rate of 3.13%. So for all the ratios like PEG, sales growth, return on equity of the 5 years on average, and return on equity even the latest years, Graphite India has done the best, whereas Panasonic Carbon at the lowest values for all of these ratios. Next, we'll look at how much the company earned on the total capital that was employed into the business on average since last 5 years. And then we'll look at the latest RoCE, what was the capital employed and what was the return on that in the recent year. And then we'll see whether the recent year's RoCE is above the average or below the average. Graphite India on average has been earning 52% on whatever was employed into the business or whatever capital was employed into the business. HEG has managed to earn a capital return on capital employed of 22%. Even Panasonic Carbon has done well to earn an RoCE of 23% on average. Latest year's RoCE was highest for Graphite India at 118%, meaning whatever capital was employed, it earned even higher profit than the capital that was employed into the business. Normally, we wouldn't see these kind of high growth rates because it is next to impossible to earn 100% on whatever was employed on the business. We don't see these kind of margins. These are exceptional gains for these companies. HEG has managed to earn 90%, whereas Panasonic Carbon managed to earn an RoCE of 18%. Graphite India's RoCE is above the 5 years average. Even HEG's is above the 5 years average. Only Panasonic Carbon's latest returns are below its average of 23%. Next, look at the return on assets of the last 5 years on average. Now, this return on assets is calculated by comparing the net profit and looking at the average assets employed by the business. Now this average assets are of the last year, and this is calculated by reducing the current liabilities from the total assets. So basically what is happening here is we're taking all the assets of the company, removing out the current liabilities, and then looking at what is the return that the company has generated on that particular assets. The company's returns on its assets employed into the business was 25%, HEG's was 12%, and Panasonic Carbon's is 15%. Here too we would want the returns to be as high as possible. This particular ratio helps us understand what was the total assets that were deployed into the business after reducing all the current liabilities. Now why we reduce the current liabilities is because these liabilities would mean, if we don't remove it, it would mean that we are also adding all those liabilities for which we have not paid. So basically it will inflate our asset returns. Next, let us look at the asset turnover, how the company has managed to calculate the asset turnover. We use the annual sales of the latest year and we divide that by the annual assets. Now the annual assets would include the net worth of the company plus any borrowings that the company has done. So this ratio would then mean that how much was the sales against the total assets that the company had. The higher the turnover, the better it is. So with whatever assets the company had, what was the multiple times or what was the sales against that particular assets which was deployed into the business. This ratio helps us understand how well the company is doing in turning over its assets into sales. Graphite India managed to turn over its assets by 1.3 times into sales. HEG also was very nearby at 1.3 times. Panasonic's Carbon's sales were lower than what it had deployed into the business as assets. Next, we'll look at the RoIC or return on invested capital. To calculate the return on invested capital, we need to understand two things: what this return is and what was invested into the business. So the invested part was the total net worth of the company, or the net block, or we can also say net assets of the company, plus any working capital that was deployed into the business. Without going into very technical jargon, basically what it means is whatever company's fixed assets were, net of depreciation after removing depreciation, and whatever the company had in its working capital. Working capital is calculated by removing the current liabilities from the current assets. So we get our working capital and then we add that with the net block. In short, it also means what was the total actual assets that were deployed into the business and what was the operating return on invested capital is used to compare the operating profit and the net block plus the working capital, that is the return from the core business. Graphite India's RoIC was 162%, HEG's was 89%, and Panasonic Carbon's was 13%. The higher the ratio, the better it is. So in terms of return on capital employed of the last 5 years on average, Graphite India has done the best at 52%, whereas HEG has managed to get a returns of 22% on its capital employed. Even in the last year, the RoCE of Graphite India was the highest, and Panasonic Carbon's RoCE was the lowest at 18%. Even return on assets was the highest for Graphite India at 25% on average. Asset turnover too was the highest for Graphite, and even on capital, invested capital, it was the highest at 162%. HEG return on asset was the lowest, and RoCE of the latest year was lowest for Panasonic Carbon at 18%. So these ratios helps us understand how the company has converted its assets, its investment capital, even its equity or its total capital employed into profits or even operating profit. So it gives us a measure of the returns that the company is able to generate on the funds that it has. Next, let us move on to the other ratios. Profit after tax of the last 5 years on average, and then we'll compare out of this profit how much was converted into cash from operations of the last 5 years again, and what was the free cash flow remaining with the company in the last 5 years. These three ratios we'll look at together. To do this, we'll need a comparison between how much of the profits was converted into cash with this ratio, CFO to PAT comparison, and then out of the cash flow from operations, how much was still remaining free with the company. That we would do with the FCF to CFO comparison. So these five ratios together will look at. So basically we are going to look at three ratios. The profit after tax of 5 years, which denotes what is the company's profits after the tax over the last 5 years. Then we will check how much of this profit was converted or came in through cash, that is the operating cash flow of the last 5 years, from cash from operations or operating activity over the last 5 years. And then finally we will look at how much was the free cash flow of the last 5 years. Now this is calculated by considering the cash flow from operating activities, and we have to deduct the fixed assets purchased, and we have to also add if some fixed assets are sold. So we get our free cash flow from investing, and we deduct this from the cash flow from operating activities. So Graphite India's cash was short by 19% over its earnings. In March 19, the company showed an earning of 4,600 CR, wherein the cash that came in was only 3,700 CR, which was 19% short or less than the profit after tax. Here, as investors, we would want to see a value which is greater or equal to the profit after tax. That is, the cash coming in should be at least equal to the profit or more than the profit. So that basically shows that whatever the company has shown as earnings is getting translated into cash. HEG managed to earn 75% more cash than its earnings. It had earned a profit of 1,160 CR in 2018. This data is available till 5 years, and cash flow from operations earned was 2,042 CR. That is, it had 75% more cash coming in against the profit. This is what as investors we should look at. Panasonic Carbon's cash was short by 10%. Next, when we look at the free cash flow to the cash flow from operations, this signifies what portion of the cash was used up in the investing and how much was left over as free to be distributed to the shareholders or for acquisition or any financial activities. So here we have used up only 6% of the cash from operations into the investment activity. Here investors should look for a figure of not more than 50%. That is, whatever the company has earned as cash, not more than 50% of that should have been utilized in investing activities. HEG also managed to keep majority of cash that it earned, and 17% of that was utilized in the investing activities in the last 5 years. Similar is the case for Panasonic Carbon, whose investing activity was 16% of the cash from operations. So most of these companies do not have a major investments during the last 5 years of what it earned in cash. So in terms of cash conversion from the profit, HEG has done the best by earning more cash of 75% more than the earnings, whereas Graphite India fell short by 19% from its earnings. In terms of free cash flow, that is how much was invested in the business activities, Graphite India has invested the least and has the highest free cash flow in terms of percentage spending, whereas HEG has spent the most at 17% of its cash from operations. Next, let us look at the average profit the company has earned during the last 5 annual results and compare that with the profit after tax of the last 12 months, excluding the extraordinary items. So when we compare the profit of the last 12 months against the average, what we understand is how well the company has done against the average profit of the last 5 years. Then next what we'll do is we'll compare the last year's profit, that is of 2018, against the latest profit after tax figure that we have. This will show us the growth rate between 2018 and 2019. Then finally, we will compare how much of the profit of 2018 had got translated into cash from operations. So these comparisons will look at by comparing the profit after tax of the recent 12 months against the profit after tax of the 5 years. So we'll know what is the growth against the average of the 5 years. Then we'll look at the profit growth rate year on year from 2018 to 2019. And finally, we'll look at how much of the profit got converted into cash. So we'll begin with the profit of the 12 months. Graphite India's current 12 months profit is above the average by 267%. That is, on average since last 5 years it was earning 933 CR, whereas the recent profit was 3430 CR, which was 267% above the average. HEG's current year's profit or the latest 12 months profit is 1200 times above the average. So on average it was earning 232 CR in the last 5 years, and the latest profit of the 12 months was 3050 CR, which was almost 12 times more or 1200% more. Panasonic's growth rate in terms of average was just 8% above the average. On average it was earning 11 CR and the latest 12 months profit was 12.3 CR, which is 8.27% more. Let's next check the profit growth rate from 2018 to 2019. Graphite India's profit growth from 2018 to 2019 is showing nothing because we have the latest data of March 19. That is why we will not have the growth rate here. HEG's profit growth rate from 2018 to 2019 was 182%, which is very good. Even Panasonic Carbon's net profit growth was 0.57%, very marginal. Here we want a growth rate of at least 10% year on year. Finally, we'll look at the cash flow from operations to the PAT, how much of the cash got converted into the CFO or how much of the profit got converted into cash. Graphite India's cash of the latest year fell short by 32%. That is, it had earned a profit of 3,430 Cr, whereas the cash from operations was just 2,322 Cr, that is 32% short. We don't want the CFO to fall short of the profit after tax figure. We want it to be at least equal to it or more than the profit. That is, the cash component should be more than the profit. HEG's cash also fell short by 45%. Out of the profit earned in 2018, it was 1079 Cr, whereas the cash coming in was just 585 Cr, that was 45.7% short. Panasonic Carbon's cash also was short by 25%. So out of the profit earned of 12.2 Cr, its cash was just 9 Cr. Here we want to see a positive value and more than the profit after tax of the latest year. I have added the growth rates for the 2018 profit value, and the profit grew by 232% for Graphite India from 18 to 2019. So in terms of the latest profit closing above the average, the maximum gain was by HEG at 12 times above its average, whereas Panasonic Carbon managed just 8% above the average profit. YOY, the highest profit growth rate from year to previous year was Graphite India at 232%, and Panasonic Carbon's profit grew at just 0.57%. In terms of cash conversion from the profit, Panasonic Carbon managed to convert the maximum profit into cash and fell short by just 25%. HEG's cash from profit didn't get converted by 45%. Next, let us look at the quarterly sales growth rates, that is quarterly sales growth as well as quarterly profit growth, and even year on year profit and sales growth rates. So we'll look at the sales growth rate. This is year on year growth in quarterly sales, example from March 18 to March 2019, and growth value should be greater than 10%, whereas QOQ sales growth rate is as per the latest quarterly result, and for an example from December 2018 to March 2019, and growth should also be greater than 10%. So we see the Graphite grew its YOY sales growth by 27%, which is a good value, but the quarter on quarter, that is from previous quarters, that is December 2018, it fell short by 8.73%. Sales dropped by 8.73%. HEG's sales grew by 4.19% from a previous year's quarter, that is from March 18 to March 19, and from previous quarter it fell short by 27%, which is a big fall in sales. We want the sales to grow because sales is the most critical part of any company's data that we can analyze. Panasonic's year on year sales grew at 18%, whereas from the previous quarter it fell by 1.28%, a marginal drop. Let us look at the profit, how the profit is growing YOY as well as QOQ. Profit grew by 14%, sales also grew by 27%. HEG's sales grew by 4%, but profit fell by 17% from the previous year's quarter. Panasonic Carbon's both profit and sales both grew at double digit. When we analyze from the previous quarter, Graphite India's profits fell 26%. Even sales had dropped by 8% from the previous quarter. HEG's sales dropped 27% and profit dropped 39%. These are huge drops in profits and sales figures. And Panasonic Carbon had marginal drop in sales of 1.28% and profit also fell by 1.72%. Now what these ratios signify is the short-term picture of what is happening in the company currently. Previously we checked the 5 years data of how the profit was getting converted into cash, and then we checked the 1 year or the latest year's data of how the profit again was getting converted into cash, and now we are looking at the very near term picture of quarterly analysis. So this way we have a complete picture of how the company has performed over long term, medium term and very near term in terms of sales growth, converting of profit, etc. Next, we will look at the net worth of the company. This is company's net worth or total book value, and net worth is basically selling all assets and clearing all liabilities, and whatever remains is the net worth of the company. Contingent liability will be compared with against the net worth of the company. Contingent liability is from the balance sheet, and these liabilities are not recorded in the financial statements or in the balance sheet. These liabilities are in the notes section of the company, so investors have to be careful that the company's contingent liability, that is those liabilities which may or may not arise in the future, do not exceed a certain percentage of the net worth. In this case, we don't want the contingent liability to exceed 20% of the net worth. For that, we'll use this ratio and compare the contingent liability with the net worth of the company. So in case of all the three companies, the contingent liability is below 20%, and in terms of net worth, Graphite India is the largest of the three, whereas HEG is at 3,700 CR, and contingent liability is within 20%. So in terms of YOY sales growth, Graphite India has done the best at growing its sales by 27%, whereas HEG managed just 4% sales growth. In terms of quarterly sales growth, HEG saw the maximum fall in sales at 27% compared to Panasonic, which just saw a minor 1.2% drop in its sales. Profit wise, the maximum profit drop was seen in HEG at 17% from its previous year's quarter, whereas maximum gain was in Panasonic Carbon at 14% YOY. In terms of Q over Q, again HEG saw the maximum drop in its profit of 39%, whereas Graphite India saw a drop of 26%. Net worth wise, the largest company was Graphite India at 5,350 CR. Contingent liability was lowest for Panasonic and highest for HEG at 3.46%, although nominal, but in the group company it was the highest. Next, let us check the debt to equity ratio and the interest coverage. Along with this, we will also look at the debt to profit. Now, debt to profit basically is a comparison of the current year's profit against the total borrowings that the company has. So we don't want a very high borrowings against this year's profit. For example, if the company has made a profit of 100 CR, then its borrowing could be 500 CR or 600 CR. That would mean that with current year's profit, or at the rate with which the company is earning its profits, it can cover this 500 crore of debt within 5 years. So that's a good range to understand where the borrowing is compared to the current year's profit. The interest coverage, on the other hand, is the EBIT, that is earnings before interest and tax, and we divide that by the interest expense. This particular ratio tells us what is the interest that can be covered or that can be paid using the earnings before interest and tax of this year. So for example, if the EBIT was 100 CR and the interest cost was 20, then the 100 can cover 5 future years interest payment, or basically it can cover the interest cost of the next 5 years. This is how we understand the interest coverage. And debt to equity, as I mentioned, that is the debt, the borrowing that the company has done, the total debt of the company upon the funds from the equity shareholders. Here we don't want a very high debt or very high borrowing when compared to the contribution of the owners or the equity shareholders. When the borrowings are more, the company will have to pay more interest to the banks or financial institutions from which it has borrowed, and that would basically mean that lower profits for the shareholders. So let us begin with the analysis of the debt to equity ratio of the company. Most of these companies have very low debt compared to the equity contribution, and their coverage is also very high. Since Panasonic has no debt, there is no question of covering the interest. Debt to profit wise, we want it to be as near as the profit. So if the profit, whatever profit the company is earning, the debt should be as near to that profit as possible. The further away, the more borrowings the company has done. Or it could also mean that the company has earned less profit against the borrowings of the company. So we want the profit to be more or as near as the borrowings, or alternatively we can say we want the borrowings to be as near as the profit. Most of these companies have managed to keep their borrowings below their profits. So borrowings is just 0.11 times its profit of Graphite India of March 2019. HEG's borrowings are just 0.62%, slightly more than half of the profit of this year. So even if it wants to clear off that borrowings, it can very easily do that with the last year's profit that the company has earned. Panasonic has no borrowings, so there's no questions of profit covering the borrowings. So in terms of these three ratios, Panasonic has done the best because it doesn't have any debt. So coverage would be maximum and there would be no borrowings against the profit of the company. Whereas HEG had a slightly higher debt of 0.18 times its equity contribution. Thus its coverage also was low at 261 years. And the debt or borrowings against the profit was also high at 0.62 times of the profit. Although these numbers are still very good even if you look in the standalone way as a standalone analysis, but when compared with the group, this seems to be the highest. Next, let us check the change in promoter holding from 3 years past, or from where it was 3 years back, and what is the current promoter holding, and if the promoters have pledged any of their shares with the financial institutions or outside the company and taken loan against those pledged shares. Now when we look at the change in promoter holding over the last 3 years, we should make sure that the promoter holding hasn't decreased at a substantial pace. We want the promoter holding to be as good as what it was 3 years back. So this gives us an idea whether promoters have sold their stake in the company from 3 years past and what is their current holding compared to where it was 3 years back. Most of the companies have not changed their promoter holding. In fact, HEG has increased its promoter holding by 0.2% from 3 years past. Current promoter holdings are very high at above 60% for all the three companies. That is very good. We want the promoter holding to be above 50% or even 40% because that gives us confidence that promoters are still holding on to their stock or shares and have a high stake in the company's well-being. Next, we'll look at the pledge. Since none of the companies have any pledge, but let me explain what the pledge is. This is the percentage of the promoter holding which is pledged with the financial institutions. we don't want the pledge to be more than 20% of the promoter holding. That is, it should be less than 20% of the promoter holding. Now, when the promoters start pledging their shares or start giving their shares to the banks and take out loan against that, they are basically in a way selling off their shares, although not directly but indirectly, if they don't release that pledge in the future. Now, many a times when promoters pledge a very high percentage of their holdings as pledge with banks, and they don't release that pledge or put a collateral against that pledge when the banks ask for a collateral, then the banks have a right to sell off those shares in the open market, and consequently, because of that, the share prices can fall at a very fast pace. So we have to make sure that the promoter holdings and promoter pledge is not at very high percentage. Next, let us look at the debtors to sales comparison. This is the latest year's sales, and we compare that with the accounts receivable to be collected from debtors. So basically what we are doing here is comparing this year's sales against what is pending to be collected from the debtors or from accounts receivables. This is the average of the accounts receivables against the sales of this year. This helps us understand how the company is collecting payment, whether the collections are efficient enough to not exceed a certain percentage of this year's sales. So we have that debtors should not exceed 30% of the latest year's sales value. Most of these companies have managed to keep their current accounts receivables or money to be collected from its customers within 10% for Graphite India, 18% for HEG, and 7% for Panasonic. Now, when the debtors or the accounts receivables are pending for a very long time and a huge amount for that matter against this year's sales, then basically the company is not receiving money for whatever sales it has done to the customers. And when there is a substantial amount still pending to be collected, it means the company cannot utilize that money for growth internally, and it will have to do more borrowings if it wants to grow or increase its sales. So the faster it can collect money from its customers, the better it is for the company. Let us look at the debtor days. This is the days within which the company collects payment from its customers. Collection period generally should not exceed 90 days. That is, the company should not give more than 3 months of credit period to the customers. If it is also getting 3 months of credit period to pay to the customers from whom or from people from whom it has purchased goods, then it's okay, because it is also getting 3 months of credit, and it is giving 3 months of credit to its own customers. So this way we can understand how fast or how efficient the company is in collecting payment from its customers. The debtors days 3 years past or 3 years back basically tells us what were the collection period days 3 years back and how it has improved or has become worse now at the current year. Graphite India's current collection period is 39 days, whereas 3 years back it was 112 days. So it has definitely improved its collection period. HEG's collection period 3 years back was 120 days, and now it is 129 days. So this has worsened because the company is taking more days to collect payment from its customers. Even 3 years back, the collection period was very high at 120 days. Many a times what happens is, if the company's products are not in demand, and if the company wants to generate that demand, it will have to give credit to its customers so that they can also pay after buying the goods from the company at their own pace. This way the company makes sales and it also collects within a reasonable period. But here the debtor days 3 years back has performed very poorly for both the companies. Panasonic was collecting within 35 days even 3 years back, and as of today it is collecting within 22 days. HEG's promoter holding has decreased by 0.2% or increased in fact by 0.2%, and there was no change in promoter holding for both the other two companies. Promoter holding currently is highest for Graphite at 65% and lowest for HEG. None of the companies have pledged any of their shares. The maximum debtors were for HEG at 18% of its this year's sales, whereas the lowest debtors were for Panasonic at just 7% of the sales. Fastest collection was for Panasonic both 3 years back as well as currently, and the worst collection period from customers was of HEG, taking 129 days as of today. Next we'll look at the inventory turnover, how the company has done or used its inventory to convert to sales. Basically this ratio tells us how well the company has managed to turn its inventory, or how many times the inventory has been turned over into sales, and we also compare that with how it had done 3 years back. Graphite India's inventory got turned over into sales 5 times in 1 year, whereas HEG managed to do it 7 times. Panasonic's inventory was turned over 16 times. Now this ratio at this values cannot be taken as true, because many a times if the inventory holding of the current year is very low against the sales, then also the ratio will inflate. So we need to take into consideration how it was 3 years back and how it is currently. So of course Graphite India's inventory turnover has increased from 2 times to 5 times into sales. HEG also has managed to increase its inventory, where it was 3 years back, to 7 times into sales. Panasonic's inventory was now from 19 times, it has converted to 16 times. This ratio has to be looked at through comparison with where it was 3 years back. Next we'll look at the 5 years average operating profit margin, or the top line that the company has earned over a period of 5 years. Graphite's operating profit margins are very high at 42% over a period of 5 years. Even HEG's OPM is very high at 32%. Panasonic too has done well at 27%. We want the 5 years OPM to be at least 15% or above that. Next, we'll look at the net profit margin. Graphite India's net profit margin was the highest at 43.2%. HEG also has done very well to keep its NPM of this latest year at 39.3 times, and Panasonic at 28%. So as of last year, all the 3 companies have done exceptionally well in earning maximum margin on its sales. Let us look at the profit margin of the companies 1 year before that. Graphite India's margin was 31% even 1 year back. HEG's profit in fact had a loss of minus 5.83%. So from there it has improved substantially. Panasonic's profit has in fact was higher at 32%, and it has decreased to 28% in the latest year. Let us look at the current ratio and the quick ratio. Before that, let me put one more point here. We want the NPM to be at least 10% and above that. Next, let us look at the current ratio. This is the ratio which measures how well the company is in terms of liquidity position. That is, how well the company can pay off its current liabilities. Current means those liabilities which needs to be paid in the current year, and we in this current ratio we are measuring how much liability it has to pay in this year and how much assets it has if it has to pay off those liabilities by selling these current assets. So here we understand that current assets are 2.93 times more than its current liabilities. So it has a good liquidity position. All the three companies have a good liquidity position. In fact, Panasonic's liability is very low, or we can say that its assets, current assets, are higher than its current liabilities. Quick ratio measures the it is very similar to current ratio, but except that it only considers those assets which can be sold off quickly without waiting, or which are difficult to sell off. We exclude those and include only the ones which are easily convertible to cash to pay off the current liabilities. So in terms of quick ratio, the ratio falls to 1.2%. Here too we want the ratio to be at least 1 or above 1. That is, this year's current or quick assets can pay off all its current liabilities. Similar is the case for HEG, having a quick ratio of 1.75 times. Panasonic again had the highest quick ratio percentage. Finally, we'll look at the dividend yield of the company. The highest dividend yield as per the current price is of Graphite India at 13%, and HEG worked out to 6.28%. Since these companies have earned a very high profit in the recent years, their dividend yield has also increased accordingly. Panasonic was paying 3.4% of dividend yield. So in terms of inventory turnover, HEG has done the best, where it was 3 years back. Highest 5 years OPM average was earned by Graphite, and the lowest OPM margin was of Panasonic. Net profit margin wise, that is of 2018, maximum was of Graphite at 43%, and the lowest was Panasonic. Even previous NPM, if we look at, HEG had a loss in 2017, whereas in 2018 it had a profit margin of 39%. Current ratio wise, Panasonic had the highest assets to cover its current liabilities, and quick ratio also, Panasonic's assets were enough to cover the quick liabilities or current liabilities. The worst in current liabilities was 1.21% for Graphite India, where its assets were enough to cover the liabilities at 1.2 times. Finally, looking at the dividend yield, the maximum dividend yield earned was by Graphite India, and Panasonic Carbon gave the least dividend yield of 3.4%. So this completes our analysis of these companies, and the maximum score we see is of Graphite India at 99 points, and HEG and Panasonic at the same 69 points. Even then, I would say HEG is much better because it is a slightly bigger company than Panasonic, and it is better to invest in a slightly bigger company than a small cap company. Thank you for watching this video.